Hello everyone, welcome to Building Accountants. Today we'll be discussing non-current assets. We want to know how to compile the PPE note, but first we need to break down a few concepts to understand the final picture. We'll first have a look at what an asset is and the different kinds of assets and their examples. An asset is a present economic resource controlled by an entity as a result of past event. Non-current assets are assets that are expected to be controlled by the entity for a period longer than 12 months. Current assets are assets that are expected to be controlled by the entity for a period less than 12 months. Our examples of non-current assets are land, buildings, vehicles, equipment, machinery, etc. And examples of current assets are inventory, cash and cash equivalents, trade debtors, prepaid expense, etc. Tangible versus intangible non-current assets. Tangible non-current assets are assets that one can experience with one's natural senses and are controlled by the entity for longer than 12 months. And the examples are buildings, vehicles, equipment, etc. Intangible non-current assets are assets that one cannot experience with one's natural senses and are controlled by the entity for longer than 12 months. Examples are trademarks, patents, mining rights, etc. Cost at initial recognition. An asset is recognized in the accounting records when the cost can be measured reliably. The cost of the asset consists of the purchase price, which is historical cost, and other costs in order to get the asset to a location and condition so that it is ready for use. And the other costs that I get the asset to a location and condition that is ready for use are legal fees, agent commissions, import duties, non-refundable taxes, and we can get trade discounts and other rebates deducted from the cost of an asset. If an asset is bought from a foreign currency, it will be recorded in SA rands in the entity's records. Now let's have a look at what is required of us before looking into the info provided so that we can extract only the information that is going to assist us to provide the answer. The required: calculate the cost of the asset. Information provided: 1 January 2021, ABC Traders purchased equipment for 1 million with 10% trade discount. ABC Traders incurred freight cost of 55,000, custom duties of 12,000, and installation costs of 5,000, which were all paid for in cash. And then now our solution: we have the purchase price less our trade discount. How we're going to get that is 1 million less 10% of the 1 million, and that will give us 900,000. Another way you can do that is 1 million times 90%. And then we have freight costs that we need to add, custom duties, installation costs. All of that is added to the purchase price, and then now the total cost of the asset is 972,000 rand. Measurement after recognition. PPE makes provision for recognition of assets based on two models, namely cost model or evaluation model. How we account for things in the cost model will say cost less the accumulated depreciation and accumulated impairment loss. And in the revaluation model, we use the fair value, which is the revalued amount less accumulated depreciation and accumulated impairment loss. How do we get the fair value? The fair value needs to be determined by a son appraiser who will measure the cost regularly and reliably to ensure relevance and not to be materially different. Now we have a look at accumulated depreciation. If you don't know what depreciation is, please go check out my video on depreciation. Then you can get back here and continue. The depreciation expense per year is accumulated over the useful life of the asset, and it is a contra asset account, a negative asset in essence. As accumulated depreciation is treated as a negative asset, it is credited in the general journal and in the general ledger. This account forms part of the statement of financial position account section, and it is cumulative in nature. We have three different depreciation methods, namely straight line method, diminishing balance method, and the production unit method. We're going to discuss the second one and the third one. The video on depreciation explains in detail how you account for the straight line method. Diminishing balance method. The formula is cost less accumulated depreciation times the depreciation rate times the number of months you've had the asset in the particular financial year divided by 12, which is the number of months. The depreciation reduces every year, hence it is called reducing or diminishing balance method. An asset is depreciated over its useful life. If an asset was purchased during the financial year, two timelines must be used. One will represent the financial years of the entity. This will be handy in recording the depreciation that was provided during the financial year and for the net value in the financial statement. The other one will represent the useful life of the asset. Each time that an asset has completed a useful life, the carrying amount of the asset will change in order to calculate depreciation for the asset's new useful life year. You will have one timeline if the asset was bought at the beginning of the financial year. Now we're going to have a look at an example. So, on 1 April 2020, ABC Traders bought a delivery vehicle for $500,000. They're using the diminishing balance method, 25% rate, and they have a December year end. So I have my two timelines done a little bit differently. So there's the one timeline from 1 January 2020 to 31 December 2020. Another one, 1 January 2021 to 31 December 2021. So the first timeline has 3 months, has 9 months, right? I've marked the timeline with those numbers. The second one, same thing as well. So our depreciation, we've had the asset from the 1st of April, and the period 1st of April 31 December is 9 months. So in the first year we're going to have 500,000 times our rate 25% times 9 over 12. We get our depreciation for the year end 31 December 2020 of 93,750. For our second year, we have 500,000 times 25% times 3 over 12, which gives us a depreciation of 31,215. And then now that the asset has been in our business for a period of a year, we must use the accumulated depreciation to get the carrying amount. So we're going to say 500,000 less 93,750 less 31,250 times 25% times 9/12. And that gives us a depreciation of 70,312 rand 50 cents. And the depreciation for the year ended 31 December 2021 will be the 31,250 plus the 70,312 rand 50. So now we are looking at production unit method. The formula for it, cost less residual value if we're given, divided by the total estimated units produced or troubled times the actual units produced or troubled for this particular year. The method provides depreciation according to the actual usage of an asset. If the vehicle was used for only 4 months during a financial year, but traveled a distance of 80,000 kilometers during this time, depreciation will be provided on the actual distance traveled and it will not be apportioned on a time basis. Example, on 1 August 2021, ABC traders bought a second-hand vehicle for 540,000. The total distance needs to travel is 300 kilometers. It has traveled a total of 65 kilometers at the financial year end with a residual value of 150,000. At the beginning, it had already traveled 25,000 kilometers. So now remember the formula, cost less residual value divided by estimated units traveled times actual units traveled for this year. So we have the historical cost of 540,000 less our residual value of 150,000 divided by 300,000 kilometers multiplied by 75,000 kilometers less 25,000 kilometers, and that gives us 52,000 rands as our depreciation. So we want what the vehicle has traveled when we have started using it. Hence, we're deducting the 65,000 from the 25,000 kilometers it had at the beginning. So now we're looking at asset realization. The purpose of asset realization is to determine the profit or the loss we have incurred after we have disposed of an asset. Asset realization is also known as asset disposal, and 4 possible asset realizations will be discussed, namely the scrapping of an asset where no profit was realized, where a loss incurred, the trading of an asset and a loss was incurred, the selling of an asset where profit is realized, the selling of an asset where loss was incurred. Record the scrapping of the asset on 31 December 20.8 for ABC traders in the General Journal. The information provided on 31 December 20.8, the end of the financial year, ABC traders decided to scrap a machine that was purchased on 1 January 20.3. The cost of the machine was 200,000 and the total accumulated depreciation on 1 January 20.8 amounted to 160,000. Depreciation is provided annually according to the straight-line method and amounts to 40,000 per annum. Depreciation for the current financial year has not yet been recorded. So this is the final answer. I won't go into detail with this one because it's just short and simple. You can try doing it on your own and see if you're going to end with this result. But with the other example, I'll go into detail because they very much similar. Now we're looking at the trade-in. Record the trade-in on the old machine and the purchase of the new machine on 31 December 20.8 for ABC traders and general journal. Information provided to you. On 31 December 20.8, the end of the financial year, ABC traders decided to trade in their old machine on a new machine. The new machine cost 480,000 and the supplier XYZ Machines was willing to trade in the old machine for 60,000. The old machine was purchased on 1 January 20.6 at a cost of 200,000 and the total accumulated depreciation on 1 January 20.8 amounted to 80,000. Depreciation is provided annually according to the straight-line method and amounts to 40,000 per annum. Depreciation for the current year has not been recorded. So the first thing that you're going to do is record the depreciation for the year of 40,000 which was given to you. You debit depreciation, credit accumulated depreciation on machinery. Now what you want to do is you've disposed of an asset and the cost of the asset was 200,000. So the disposal of the asset at cost price, you're going to credit your machinery and then you're going to debit your asset realization account. And then now the total accumulated depreciation we have, it's the 80,000 that was given on the information plus the 40,000. So when you're taking your accumulated on depreciation on machinery to your asset realization, you'll be taking 120,000. So you're going to debit accumulated depreciation on machinery because now you're taking out the accumulated depreciation of the machinery because the machinery will no longer be in the entity. So you're also going to record the new machinery of 480,000 and you're going to credit your creditors control. You can also write XYZ suppliers and then you're going to debit creditors control with 60,000 and you're going to credit asset realization because that's the value of the trade-in. And then the transaction results in a loss on sale of an asset of 20,000. You're going to debit the loss and you're going to credit asset realization with 20,000. And then now the closing transfer or the closing transaction would be profit or loss of 20,000 and you're going to credit your loss on sale of asset with 20,000. Now this is the whole idea of this video. You want to know how to be able to draft our property, plant and equipment note, and this is from our example we just did with the trade-in where the cost was 200,000 and the accumulated depreciation at the beginning of the year was 80,000. Then we have our movements. We have acquired this new machinery for 480,000 and we at the disposal of the machinery the amount was 80,000 and the depreciation for the current year was 40,000 and at the end of the year the cost is 480,000 because we've disposed of the other machine, and as we have disposed the asset at the end of the year the depreciation will be 0. Now we're continuing with ways of disposing of an asset. We're looking at selling the asset at a profit. Record the sale of the asset on 31 December 20.8 of ABC traders in the general ledger asset realization. On 31 December 20.8, the end of the financial year, ABC traders decided to sell a machine for 150,000 cash. The machine was purchased on 1 January 20.6. The cost of the machine was 200,000 and the total accumulated depreciation on 1 January 20.8 amounted to 80,000. Depreciation is provided annually according to the straight line method and amounts to 40,000 per annum. Depreciation for the current year has not been yet recorded. The bank had a favorable balance of 550,000 on 1 January 20.8. So now we have our T account asset realization. We want to know how much is the profit on sale of asset, as the example that we're dealing with, we're going to have a profit on sale of asset. So we know that the machinery at cost was 200,000, so we're going to debit machinery with 200,000. The accumulated depreciation on machinery, the 80,000 that was given at the beginning of the year, and the 40,000 depreciation for the financial year. We add that together, the 80,000 and the 40,000, we have 120,000 as our accumulated depreciation on machinery, and then we sold it for cash. Therefore, we're going to create our bank in our T account asset realization for 150,000, and then now we want to know the difference, because our asset realization T account needs to be left with a zero balance. So the difference between the credit and the debit side is the 70,000, which will be our profit on sale of assets. We got the sale of the asset on 31 December 2028 for ABC traders posted to the general ledger asset realization account. On 31 December 2028, the financial year end, ABC traders decided to sell a machine for 60,000. The machine was acquired on 1 January 2026. The cost of the machine was 200,000 and the total accumulated depreciation on 1 January 2028 amounted to 80,000. Depreciation is provided annually according to straight line method and amounts to 40,000 per annum. Depreciation for the current year has not yet been recorded. So we're going to debit machinery with the historical cost of 200,000 because that's what we're disposing of, and then we're going to get the accumulated depreciation on the machinery out of our books by crediting the accumulated depreciation on machinery of 120,000. So how we got that 120,000 was the depreciation at the beginning of the year that was given, 80,000 plus the 40,000 depreciation that was not yet accounted for in our books. Then we have our bank, 60,000 as given on the information, and then now we have to work out the difference, as you know now that we're not supposed to have any balance on our asset realization account, and the difference is 20,000, which results as a loss on sale of machinery or loss on sale of the asset. Let's have a look at intangible non-current asset. So intangible assets, excluding goodwill, financial assets, and mining rights, are an identifiable non-monetary asset without physical substance that is separable from the entity arising from a contractual or other legal right, and the probability of future economic benefits should exist, and the amount at which the asset is recognized should be measured reliably. Intangible assets are created and established through a legal process. The entity obtains the asset either by registration of the right or by acquiring the right from another party. Amortization of assets. Intangible assets have a legal life. This means that they have a limited useful life. The cost of the asset can also be allocated per financial period over the useful life in the same manner as depreciation of tangible assets. The difference is that this is amortization. Amortization is calculated using the same methods, namely straight line method and diminishing balance method. Amortization starts when the intangible asset is available for use. This implies that the intangible asset needs to be in a location and condition to be used as intended by management. Amortization is calculated on an annual basis and is generalized by means of the amortization account, which is an expense account, and the accumulated amortization account, the contra account